Hi, thank you. I'm, again, Brian Kearney, Wall Street Journal editorial page here in London. The idea here is just to try to wrap up and think about what we've heard and what we've learned. And I'm going to go to Neil first, and then to John, and then to Lee for some brief comments. And I, like Alistair, probably won't be able to resist interjecting a few of my own along the way. But Neil, the floor is yours.
Well, thank you. You've already heard from me on a couple of topics, including the Eurozone. I thought I'd avoid that. In fact, I thought I would introduce another one which has been remarkably absent in this debate, which is the investor's position. And the typical investor, I'm an asset manager, so these are my clients. The typical investor is a pension fund or an insurance company, and they are time shifters. So they take in the contributions of employees. They invest them over probably 20, maybe 30 years, and they need a return if a pension is to be affordable. And they are under extreme pressure. The flavour, if you go to a pension fund conference, UK, US, it doesn't matter, is one of disbelief how bad things are. And it comes from two directions. One is well documented that we have a demographic time bomb, that the obligations that their employer, that the sponsor, thought they were taking on 20 or 30 years ago has doubled or probably trebled over that time, because the guy retired at 65, you thought he would die in his 70s, he's now dying in his mid-80s. That's an enormous increase on the one hand. And on the other hand, there has been, I'm afraid, a huge gap between the realised ex-post returns of their investments, which have been, well, certainly the equity risk premium has been zero and negative over 20 years, the first time in quite a long time, probably a century, that that's been the case. But I think almost more importantly, they have been inured to an institutional optimism about returns. And so the way it works, and actually it's a pity we're missing Matt Hancock, because this is an ongoing debate in UK public sector pensions. The way it works is that the contribution the employer makes for each year, or the employee, for each year that they work to give themselves a decent pension, requires that they make an excess return over risk-free rates. If they don't make that excess return, they won't get the pension they expected, and or the pension fund will be in a large deficit and the sponsor will have to pay. And the difficulty is, I think, just in terms of market failure, I think there's been a breakdown between what I would call the wildly over-optimistic expectations about what investment returns can deliver over the sorts of periods that we're talking about and what they have delivered. And there's been an incentive mismatch that's meant that politicians, that finance directors, that asset managers, that pension managers have all continued to believe in artificial interest rates. And the Americans, there are probably a couple of nodding Americans, the discount rate argument, particularly in US state funds, is a huge issue that they've been racking up. You can keep your pension fund looking solvent if you keep on racking up your discount rate, assuming higher and higher returns. We've done that in the UK in our unfunded schemes as well. Now, this is crazy because we don't have any funds, and yet we're assuming risky returns, not risk-free. And so we're contributing about 20% of pay each year for our defined benefit pension schemes for our public sector pensioners, whereas the cost is over 40% of pay. And we're saying, well, we'll get excess returns, but there are no excess returns because there are no funds. So this just seems to me to be, so that, I mean, that's just put it one side, but in the world that I move in, the financial crisis, the direct implication, forget the politics, forget the banking system, on actually one of the core players, which is the saver in all his forms, has been very damaging indeed. And my opinion is we still have a very large amount of the pain that that's going to imply to roll through the system.
Thank you.
Right. The reason I'm writing something down here is because somebody said we have to be punchy. You know, this This is a time when everybody's really getting bored. I know, honestly, I can see it. I used to teach. I could see on people's faces the horror of boredom, and anyway, that's another story. So, so I want to keep mine brief because I know Lee actually has something interesting and new to say. So I will just make 3 points. I've written all the things that everybody had said down, and I'm not going to use any of it, but it's a summary. I think one of the things that has come out of this and many other conversations I've seen and had is that I think people, whether it's the elite intelligent people or it's the ordinary guy, who are aware that something very big happened the last 5 years. They're aware that there was something huge, systemic, and unprecedented. I think that awareness is with us, and I think it is actually the backdrop of almost everything that's happening, whether it's election campaigns in the U.S. or the discussion here. I think number 2, I think there's a general consensus that big changes are needed, or we're going to have big problems of a different kind in the future. And I think there's the sense of that. And Matt, whether it's banks having living wills and all that kind of thing. I think the third and last point I'm going to make is I think there is doubt about whether those big changes are good or bad. So I will give you just 2 examples. One of them, Randy Quarles, maybe I'm misphrasing what you said, but essentially what I think he said was that central banks are actually doing things that they never did before. They've shifted from referee status to player status. As a result of that, they are engaging in an intervention in the way our world works that could lead to very massive problems in the future. So that would be a change that's happening, that's big, but where there's some doubt whether it's in the right direction. The other side of the coin is something like the great banks we've been discussing. And while I have not read Dodd-Frank, I have a very close friend who's actually read the stupid thing, and he's a very, very bright guy and very, very, experienced. And his position is that the real problem is the banks are way too big. They've gotten much bigger today than they were 20 years ago, and that regardless of whether they're going to be allowed to fail or not fail, what really is necessary is to reduce their size, to break them up. That is not going to happen. So what you're going to end up happening for the next 5 to 10 years is have bigger and bigger banks that, regardless of what happens, are going to be harder to deal with. So change is in the air. Some of it may be good, some of it may be bad, but the sense that there's an enormous thing that has to be handled, I think, is the key takeaway. Okay.
Thank you, John. I'm just going to continue. What is the right size for a bank? I can agree with the sense that they've grown and maybe some of them feel in some way too big to fail. I just don't know how you answer a question. It's like, what is the right incentive structure? What is the right time frame on which to pay a banker? It's all very well to say, we don't like the way it is now, but somebody has to come in and say they can't be larger than a certain size, which creates its own distortions, or that per Vickers, they can't do certain kinds of things regardless of their size. These problems are
they're big,
deep and difficult. Maybe it's why we can't. Anyway,
but
sorry.
Brian, I have to say this one thing, just because I realize this is not. But here's an example. I asked this guy. You'd have to know this person, know why I have such trust in him. But I asked this guy, how big a bank do you now have to be to survive in the U.S.? He said at least 100 billion of assets. 100 billion of assets used to be quite a lot of assets. So if you were to say something like that in the technology field, that you have to be, have a 100 billion market cap in order to succeed, people would say there's something wrong with technology. So I think part of what's going on here is that when 6 banks control 85% of the assets in the U.S. and used to control 30%, people are looking and saying there is something wrong with the picture. We don't know how to fix it. And I think part of starting to fix things is to actually begin to understand what you don't know, which is I don't think we've done enough of. Anyway, I've said too much.
Only respond, if you have to call a bank systemically important, then it's too big, and it's probably too big to fail. I think that that if there's any test the new regulations that have come up in the U.S. and the UK have already failed that in that respect. One of the things, and I don't know how new necessarily and interesting my comments will be, but because the
John
past
already
panelists,
sold you up.
I
Man.
know,
Don't
but
say
the
that.
past panelists did such an able job of tackling so many issues. But I think the one thing that did stand out is we're talking about capitalism and a crisis in capitalism, and even potentially a failure within the capitalist system. But I think more specifically, and this is the heartening thing, is that really, in many respects, we're really talking about finance. And there was a problem with the way the financial markets worked, and we can go through all the causes of that. But at the end of the day, capitalism, whether is viewed favorably, certainly in the U.S., nobody's targeting Bill Gates and Mark Zuckerberg. Even the industrialists in the U.S. are not treated like they were several decades ago, like an Andrew Carnegie or Vanderbilt, who were demonized in a much more vicious manner than anyone who controls a manufacturer these days. So really what we're talking about is the crisis within finance. And I think a lot of, and just going to the kind of what do people view as the role of finance in a society, just in terms of the basics of allocating capital and providing liquidity, and what became so dysfunctional about those very basic operations. I think a couple of things, and this is feeding off a lot of what people have mentioned already, but I think it brings some of these themes together. One of the major things that happened over the last decade or so is the disintermediation of finance. And in part, this was to provide more liquidity and to allocate capital better. I mean, you provide an opportunity for people who could never own a mortgage or invest in a mortgage to now buy one. But the process of that occurring is you have a broker making a loan, him selling off that loan and getting it underwritten by a bank, who then sells it off into a trust, who then sells bonds based on that asset. And voila, you have many more investors in mortgages than you previously had, and that's a great thing. But at the same time that you have this intermediation, you have a lack of ownership, as it were, in the underlying asset. And the mortgage broker who sells it on says, good, I've made a fee, I'm done with this. The bank that underwrites it makes a fee, they're done, they've underwritten it, it goes into a trust, and those people holding the paper at the end of the day were not sophisticated enough or didn't do the homework enough to understand exactly what risks were underlying there. But the whole chain, even the homeowner in the original instance was he didn't really even have an ownership stake, right? I mean, when you can borrow against 95% of your house or 100% of your home, it's really just an option. You haven't invested anything. If you had to lose, 20% of your investment because that was a requirement, then, you may be a little bit more judicious about the size of the loan. So this whole idea of ownership and disintermediation, creating kind of a absence of ownership and responsibility, I think, has been a problem that we have yet to fully tackle. I think derivatives is another new and interesting innovation in finance, which has created offloading of risk in many respects, and that's a good invention because it adds to the number of market participants, but at the same time, it also allows one who holds an asset to offload most of the risk of what they hold, and they no longer have that ownership stake. And I think all of this gets accelerated by the fact that we have amazing technologies that can bundle information technologies and otherwise that can bundle thousands of mortgages into a pool and sell off bonds very rapidly based on those, and yet we can't keep up with that technology. We can't the bond investor can't understand whether all 1,000 mortgages were properly underwritten. They have no idea who that family is that provided that loan, to which that loan was made in the first place. So the technology got way ahead of us, and we have to figure that out. And I think what So I think what a lot of what happened over the last several years was relatively simple, although it's very difficult to fix. But it's really just we screwed up. We mismeasured risk. We as a society, we mismeasured risk. We didn't understand what we were purchasing, much because you had perverse incentives with the disintermediation and the lack of ownership. We didn't care as much what we owned, but we did not understand the nature of the instruments that we were buying. And as Nicole pointed out, if AIG had to actually margin what they purchased in terms of credit default swaps, they never would have made the purchase in the first place, and so they didn't understand the risk. So let's do a better job of measuring risk, and let's create understandable standards and clear standards to which all market participants globally must follow. With no special exemptions, and I think we'll be a long way towards resolving this crisis in finance, and I don't think we'll see the broader crisis in terms of capitalism, because people really don't look down on capitalism as it were.
I wonder, the missing piece in that analysis, right, is that at no point was anybody forced to buy those mortgage-backed securities, right? At no point were those foisted on unwilling buyers. And in fact, a lot of the investors in them were not sort of mom-and-pop rubes. What was the word we learned yesterday? That they were elephants or muppets, that the guy called them in the New York Times op-ed. They were sophisticated institutional investors in many cases, and if they didn't understand the risk, if they didn't demand disclosure of things that they ought to have, I don't know why we should expect that we would get right exactly what it is we need to know and how much and what that should cost and everything else the next time around. And there's a piece that did come up in the last panel, which is an important one, which is that people weren't buying this stuff in every case as free actors, right? If you were certain kinds of institutional investors, you had to own AAA, or you were given big capital adequacy bonuses for owning AAA and for owning mortgage-backed securities rather than whole mortgages, and so on. And there's a whole regulatory edifice that encouraged the purchase of this stuff. Some of which we're doubling down on with the next set of banking regulations, right? We're actually tinkering around the edges of what is considered safe, but I think that the sort of risk-free assumption about sovereign debt is the sort of may go down as sort of the great regulatory howler of the 21st century when people look back 50 years from now on what's going to happen in the next decade, and they say, we just had this crisis where the sort of regulatory mispricing of debt was a huge factor, and then you had Greece blow up, and yet we're still telling all the banks, own sovereign debt, it's free, risk-free. And, standards are good, but I think if there's a market for them, right, that there will be people who will offer those services. I'm not sure they need to be imposed from on high. I'd also say that you may need to be $100 billion to be a bank, but you don't need to be $100 billion to be a hedge fund. Most aren't. And the much demonized kind of shadow banking sector actually acquitted itself quite well in some respects in the crisis. Something like 2,000 hedge funds went bust in the 2008-2009 period. Nobody even noticed, right? There were no bailouts. There was no, and in that respect, the least regulated sector of the financial system held up quite well, despite the sort of demonization it gets for not being within the fold. In some sense, it's a model. I think it could be thought of as a model for what kind of financial system you want, one with very low barriers to entry and exit, and strong competition, and people are judged on the results, and they live and die by their sword. Unfortunately, as I said, they're less popular than ever these days, but if you look at them, they were sort of exemplars of what you would expect in many respects during the crisis, including in their ability to go bust.
They held up well because they went down well.
Yeah.
Brian, perhaps I could just,
Yeah.
I could just come in. I'm very intrigued with your idea that the great 21st century howler might be the assumption that sovereign is risk-free. And I'm intrigued because I think the stage is set for misaligned incentives for that to be the case. And I think it's the point that John and indeed many of the speakers have been making, which is that we have got a drift over from referee to player, actually. So let's just take the ECB and the associated regulatory framework. They have a structural interest in declaring sovereign risk-free. It is in their own existential interest that that's the case. And therefore, if that pervades the system, and the operators in the pure private sector have to accept that because that's how the pricing goes, because they're very dominant in pricing, then we are in a very dangerous environment, because we do have the referee, who is also a player, who says X is the case, on the downhill sloping pitch, I always go this way. You know you're in trouble. So I think I think probably that the biggest risks to global prosperity, whatever is the global economy, probably are no longer coming from the private sector. They were, and they certainly did. The private sector became very leveraged in the first decade. I think it's going to be the public sector in the next two.
Thank you.
I would just say
I
to your
have to
point
give you a
about-
chance
Oh, no.
to come back on me on that
Before
before
we
we
close up, and if you have any final remarks, John, after that, but then we have to end, so.
Well, I think one of the parts of the analysis, which I didn't mention, is that even for certain of the securities that were purchased, like government sponsored, mortgage-backed securities sponsored by the GSEs, the holders of that paper ultimately thought that they would be bailed out. So even then, somebody who purchased this paper had a view that they didn't necessarily have a strong ownership stake, because ultimately they were backed by the government. So that was look, they were right in many respects, and that came true for so it wasn't necessarily a bad bet in that respect, but they it made it easier to just buy this stuff en masse. So I think and look, the government has to be the leader in a lot of these areas. If they tell people that you deserve a home and you should be owning a home, people are going to say, okay, great, that means I can basically do anything, kind of, even if it maybe doesn't make sense to me, in order to own a home, because the government says it's appropriate, it's right, and it's okay that I borrow 98% against my home. And that kind of toxic attitude led by the government needs to be tamed, and the government needs to get out of finance for just the reasons that Neil stated, because the perverse incentives become automatic, and it only makes them get kind of more integrated, more involved in the process, and that's certainly nothing that's come out of the U.S. and the U.K. recently. In terms of regulation, specifically Dodd-Frank has tempered that. If anything, it's encouraged the existence of and codified the existence of systemically important banks. It's codified an oligopoly, as it were, and it sets a very dangerous precedent.
Thank you. John, the last word's yours if you want it.
I just want support for what Lee said, and that is, I think he's absolutely correct that one of the problems we mismeasured risk. I think he was implicit in what he said, I think, was we mismeasured risk because we had a belief that models, very complex mathematical models, were ends in themselves as opposed to very, very powerful tools. But ultimately, the judgment is what is behind models, and so part of mismeasuring risk is being aware to what degree your models are not ends in themselves, and the judgment plays a role.
All right. Thank you all very much, especially those of you who stayed to the end and therefore can hear me say that. Thank you, Amanda, for helping organize it.